Hey everyone! Today we've got some truly game-changing updates about NIO, and I can honestly say the news coming out right now is extremely bullish for the company. In this video, we're going to dive into what NIO's CEO just revealed, why this decision could actually be great for the business, the insane demand that's driving their momentum, and finally, we'll break down what investors should expect going into the upcoming earnings report. Trust me, if you've been following NIO or are interested in the EV space, this is the kind of news you don't want to miss. This is not financial advice. Please do your own research. Let's start with the headline that's got everybody talking. NIO's CEO just made it clear that the Onvo L80 will not be delivered this year. At first glance, some might think a delay is negative news. But here's why this actually signals something incredibly positive. The reason for the delay is that demand for the Onvo L90 is simply off the charts. Both the Onvo L80 and Onvo L90 share the same manufacturing line. That means if the company were to start producing the L80 right now, it would directly reduce how many L90s they could make. And because the L90 is the more premium vehicle with higher margins, it makes far more sense to prioritize it. Essentially, NIO is saying, why sell more of the cheaper model when customers are lining up to buy the more expensive one that boosts profitability? The CEO was crystal clear about the timeline. There will be no L80 deliveries this year, though he did leave the door open for a potential announcement of the model later in the year. But when it comes to actual deliveries, that won't happen until next year. What this really tells us is that the Onvo L90 is dominating demand and NIO is smartly maximizing production around the most profitable vehicle in their lineup. Now let's move to the second piece of major news, which is equally as impressive. According to people with inside knowledge, NIO has hit a record number of locked-in orders. And to be clear, we're talking about confirmed orders, not just soft commitments. For the month of August alone, NIO has racked up 57K locked-in orders. Out of those, about 15K orders come from NIO-branded vehicles, while an incredible 40K are from Onvo models. As you'd expect, the L90 is leading the charge here, but there's also been a surge of attention for the Onvo L60, which actually saw a 30% increase compared to last month. That's a huge momentum boost across the board. And it doesn't stop there. NIO's Firefly sub-brand is also gaining traction. They launched a limited Firefly edition with custom decals, and it sold out almost instantly, proving that demand isn't just limited to their big models, even their side projects are catching strong interest. To put this in perspective, let's compare with other EV players in China. In August, NIO's 57K locked-in orders put them at the very top of the leaderboard. Leapmotor came in second with 56K, while Li Auto secured 46K. Xiaomi stood at 38K, XPeng at 37K, and AITO at 26K. Clearly, NIO is dominating, and much of this success is tied directly to the momentum of the Onvo L90 and the strategic pricing adjustments the company has rolled out recently. Now, let's shift gears and talk about earnings, because this is the next major catalyst for NIO. Their Q2 earnings report is coming up in just a couple of days, and investors are eager to see whether the company's financial performance is starting to reflect the operational improvements we're seeing on the ground. First off, management has already stated that the goal is to reach profitability by Q4. That's ambitious, but it also means that the company is front-loading a lot of expenses in Q2 and Q3 to clear the path for those positive numbers later this year. So what does this front-loading look like? For one, NIO has been restructuring its workforce. That means paying out severance packages that aren't cheap. Employees who've been with the company for years are owed N+3 compensation, essentially the number of years they worked plus an additional 3 months of pay. For someone who worked 5 years, that's 8 months of salary that NIO has to pay upfront just to downsize. On top of that, they've been shutting down unprofitable retail stores. While this is the right strategic move, it comes with costs like contract termination penalties, renovation tear-downs, and other exit fees. To give you an idea of how expensive this can get, One NIO house location reportedly had tear-down costs equal to the price of a car. So, these are significant expenses being absorbed in the short term. And let's not forget, NIO is also investing heavily into Factory No. 3, which means construction and related expenses are piling into Q2 and Q3 as well. Given all this, what should investors realistically expect from the upcoming earnings? Historically, NIO has posted quarterly losses averaging around $700 million. That's a staggering number. But if, in this report, we see that losses have narrowed to around $500 million or less, that would be an extremely bullish signal. Why? Because it shows the cost-cutting measures are actually working, and that the company is moving closer to profitability right on schedule. A figure like that would almost certainly spark a strong positive reaction in the stock market. Investors love to see a clear trajectory toward profitability, and trimming hundreds of millions off quarterly losses is exactly that. Of course, the flip side is possible too. Because of all the expenses being piled into these quarters, we could still see losses stay around the $700 million mark or even higher. The key will be whether investors view these as one-time costs versus ongoing structural problems. Management has previously suggested that Q2 would show about 20% improvement in losses due to cost cutting. If that projection holds, we could indeed see results closer to the $500 million level. That's why this earnings report is so important. It's not just about the raw numbers, but about whether the company is delivering on its promises. Another critical piece of the puzzle will be NIO's guidance. The company doesn't traditionally provide specific delivery forecasts, but they do have an ambitious year-end target, delivering 55,000 vehicles per month by the end of the year. Now, based on the locked-in orders we just discussed, that target looks more achievable than ever. The demand is certainly there. The question is whether management will reaffirm their confidence in hitting that target. If they do, it's going to be extremely bullish for investor sentiment. But if they walk back the goal or signal delays, it could spook some people in the short term. So let's bring it all together. NIO's CEO has confirmed that the Onvo L80 is delayed, but for all the right reasons. Demand for the Onvo L90 is so overwhelming that it makes no sense to split production. Instead, NIO is prioritizing its most profitable product, which is a smart, bullish move. On top of that, the company has achieved a record-breaking 57,000 locked-in orders in August, outpacing every major competitor in the Chinese EV space. Looking ahead, all eyes are on the upcoming earnings report. Investors will be watching closely to see if losses have started shrinking meaningfully and whether NIO's leadership reaffirms their ambitious year-end delivery targets. If they do, we could be looking at a very exciting end to the year for NIO, with profitability right around the corner. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.